Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to financial advisors and their clients. Today we're going to talk about credit markets. This is a topic that is hitting your Bloombergs, your newspapers on a daily basis, really it seems over the last 60 to 90 days. And of course, I'm talking about some of the headlines and tremors that we're seeing in credit markets. And what we wanted to do today is dive a little bit deeper into some of those events, and then provide you all with some perspective about what this is and maybe what it's not as well, because there's certainly quite a lot of debate going on in markets about the significance of some of what we've seen. To help us in this conversation today, I'm really lucky to have Jason Duko joining us for the pod. Jason's a senior portfolio manager in our leveraged finance area. For those of you who follow credit markets actively, you'll know that leveraged finance, really it touches a lot of the areas that have been in the news lately, whether that's private credit, CLOs, bank loans, the high yield space. So it's nice to have somebody of Jason's wide-ranging capabilities and knowledge to join us for the conversation. Jason, thanks for being here.
Yeah, thanks, Greg. Looking forward to it.
It's funny, we call you Duko around the office. It's going to be a little bit weird for me to call you Jason during the podcast. So if I lapse, I apologize.
Yeah, we can go with Duko. It's fine.
It's just too many Jasons. We got a lot of Jasons running around. So hey, what I want to do is maybe just sort of kind of set the stage for listeners, and maybe really zoom out and think about credit markets this year from a top-down perspective. Anybody who's listened to the podcast or read any PIMCO research over the last couple of years already knows that we have felt that expectations, spreads in corporate credit, particularly over the last few years, have been very optimistic. Spreads have been really tight. We haven't seen as much value there as we've seen in other parts of the market. Maybe you can bring us up to date on that viewpoint, if it still holds, and give us a sense of what's happened this year, where levels are right now, and how we're thinking about just broad credit markets right now.
Yeah, thanks, Greg. It has been an interesting year because we did start the year with spreads, arguably a little bit tight. Went through Liberation Day, retraced most of that, and overall, it's just left us in a really solid total return year. I think part of that was a lot of what we've been preaching. We started the year with elevated yields. That's really helpful from a total return perspective. So, we're seeing total returns coming into the year end in the high single digits across most credit asset classes. So on the surface, a very good year. I think to your point, though, what we've been feeling and seeing in the headlines is a lot of concerns of late cycle behavior. The recent bankruptcies is the end of this kind of more benign era happening now. And what are we thinking about as we go into 26? I think that's at the front of investors' minds on the back of a solid year, really a solid year across. I think you called it on one of your recent podcasts, the everything rally, and credit did kind of benefit from that everything rally. But the way we're thinking about this at PIMCO is, as we look out to 26, we should anticipate spreads on the surface to look similar to where they are today, but beneath the surface, a lot of dispersion, a lot of bifurcation, elevated defaults, particular focus on some of the lower quality borrowers where there's less liquidity. We have concerns in that area. And I think that's going to be a challenging environment to navigate going into 26.
I know that our economic views have, we've not, called for sort of, a collapse in the economy. We have relatively benign views of overall economic performance, maybe a little bit of a slowdown off of the torrid pace of the last few years, some unknowns about if and when tariff policies will hit, and obviously some uncertainty about exactly what the Fed will do and when, but certainly not calling for some kind of large scale significant recession as our base case. I think we talk in probabilities a lot at PIMCO because you never want to get too married to a single scenario. So it sounds to me like what I'm hearing from you is a base case that overall credit market performance looks kind of placid on the surface, but we start to see more cracks, particularly in the lower quality segments of the market.
Yeah, I think that's exactly right. So when I describe the dispersion, you're seeing it today in a lot of the cyclicals. You look at chemicals, you look at autos, you look at the low-end consumer. There's pressure already, and these cracks are definitely emerging. But on the other side, you have a lot of the AI capex spending and all the tailwinds from that kind of still driving, to your point, decent economic growth overall. The Fed cutting will take some pressure off some of the floating rate borrowers as well. So, there is a mix of positive and negative drivers out there, which is why I think you'll see dispersion amongst managers, and I think it really kind of points to what we preach. Active management is going to be really critical. Trading in and out of positions, how we see credit risk developing. Do things get oversold? We saw that post Liberation Day where there was definitely some overselling. We try to capture that. So I think that'll be the goal going into 26.
So let's maybe, when we get into the meat of what's maybe caused some of these headlines and some of these worries in markets of late, there have been 3 or 4 significant events, maybe more significant by virtue of the fact that they happened than by their size or systemic importance. But can you walk us through, just over the last, 30 days, 45 days, what we've seen that has markets starting to question what previously they thought of as a fairly, I don't want to say perfect, but I do think expectations for some credit categories were, pretty much that people couldn't be wrong, and that illusion at least has been somewhat challenged over the last month or so.
Yeah, I think that's definitely emerged in the recent months, and I think the real story is there. Anytime as you see the rapid growth of an asset class such as private credit, it's grown to be close to $2 trillion in size now. That's going to come with loosening underwriting standards. Weaker players, doing weaker deals. And then when you had these 3 bankruptcies take place in recent weeks, I think it just opened people's eyes that maybe the underwriting that you thought was being done is not being done.
So so we're talking about the First Brands situation, Tricolor, all of these, well documented in news flow and advisors would be aware of. I think Renovo was the most recent headline to come across, and correct me on these names. There was one more. What was the name of that issuer?
Bankai.
Right.
Yeah.
And so I wanted to. So I think it's. There's been a debate in the marketplace as to whether or not these 4 events sort of signify, or whether they really count as an indictment of direct lending, because some of them were held by banks, originated by banks. Some of them were more, sponsor backed and involved a more, down the middle private credit lender. What's your take on that?
Yeah, I would say that Dan Iveson, our CIO, makes this point a lot. I think it's less about public versus private and more just about credit investing overall and what kind of underwriting is being done. And then most importantly, are you being compensated for that credit risk you're taking from both the fundamental standpoint and also from the liquidity standpoint? And that's where we have the biggest concerns, is that it's not necessarily systemic in any meaningful way, in our opinion. I think you are going to see elevated defaults going into 26. But I think it's more, symptomatic of, again, I don't want to belabor that point, of just late cycle behavior, looser underwriting, and more importantly, just not getting compensated. If you look at the direction of travel on the Fed, if we're moving closer to a 3% base rate, and the competition that's taking place between the public and private markets overall is leading to that spread compression.
Is it? I mean, it's interesting to me. I think we sometimes fall into this temptation to talk about different markets as if they're separate and unrelated to each other, and in some cases, that behavior is fueled by managers who are looking to raise capital, and so they talk about the uniqueness of their strategy, and we fall into a pattern of thinking of private credit as separate from public credit, or even frankly high yield as separate from the bank loan market, or the bank loan market being separate from the IG market. And and what I hear you saying is that there's a continuum of credit risk. It seems like it would be very hard for excesses in one area of the market not to generate excesses in other areas of the market, just given that the borrowers have access to all of the markets and kind of get to select where they source funds. Am I reading that wrong?
No, I think that's exactly right. And this is against a backdrop, by the way, of I mentioned this earlier, kind of the explosion of growth in private credit. CLOs in the public bank loan market have had back-to-back record years. So there's been incredible demand coming from investors because it's been a benign credit environment against a backdrop of limited supply, right? Because cost of capital has remained elevated, and CFOs have been predicting the recession for a little while from the elevated base rate. So they've been a little bit cautious on doing M&A and LBO activity. So there just hasn't been a lot of supply, and so it's just a simple supply-demand imbalance has led to your point, sponsors taking advantage of the best path forward to finance their various transactions, and they're getting looser documents, tighter spreads, and that looser underwriting standards are kind of prevalent across all forms of credit.
Yeah, and this is the dynamic that I think we've been talking about a lot on this podcast and in other client conversations, is that the success, which is most pronounced in direct lending, the success of that as an investment strategy over the last decade has led to a massive increase in appetite amongst institutional investors, now wealth investors, to be involved in that, because its trailing returns look phenomenal. And so then you have this avalanche of capital chasing, to your point, fewer and fewer deals in an uncertain economic environment and a slower deal environment. So in some respects, it's not even controversial to say that you would expect to see some deterioration in credit quality, in underwriting standards, because the race to put capital to work, it requires lenders to drop standards in order to satisfy the amount of money that's coming in from their own clients.
Yeah, I think that's exactly right. There is a pressure. I think Dan put this out there the other day when he was doing the view from the investment committee, that a lot of clients are forced to just deploy, or managers are forced to deploy. Versus at PIMCO, we like to think of ourselves as an investor and looking for better relative value opportunities across that spectrum we talked about. And so I think that's the balance that you're trying to navigate as you look forward. And there definitely is that pressure, right? You don't get paid on your capital until it's deployed, and there's a lot of competition. I think if you kind of rewind the clock a couple of years ago, the banks were kind of sidelined by the duration problems and in retreat a little bit, and so there was this great market with elevated base rates, higher spreads, and not a lot of competition. So that was a great time, to your point, and that's when a lot of this record fundraising took place, because it was a backward-looking, coming off the success of the backward-looking performance. Looking forward, I think we're saying the same thing. It's going to be lower returns going forward, and if you're expecting past performance, I think you might be a little disappointed.
Right, because you've got short rates down, which dictates the coupon you get off of a floating rate loan, and you potentially have credit costs increasing over time. And I think to be fair to the direct lending folks out there, I would imagine that manager selection will play a pretty significant role in outcomes here. If there are managers who have focused on the upper tier of quality, if they have been slower and more disciplined in capital deployment, you would imagine, all things being equal, you'd see a better outcome there with more selective, GPs involved.
Yeah, that's right, and I'm glad you put that caveat in there. I don't think it's all doom and gloom here. I think direct lending is here to stay. It actually provides a very important piece of capital to the overall market. It does offer solutions for some of these lower rated borrowers. It has more flexibility. There are definitely some positive attributes, and so I think it's here to stay. And you can see the dispersion that you're describing even in the BDC prices today. Not all managers are trading at the same level of discount in terms of their stock prices today. So
so that's you mentioned the BDCs before, and I so let's talk about that. Tell us about what you're referring to when you reference kind of the public BDCs and what you learn by their trading patterns.
Yeah, I mean, you mentioned in the cook-off that you can't help but see the headlines every day. There's some kind of new headline related to the credit space, and a lot of times it has to do with the private credit space because we all know that it hasn't really been tested. It's been a pretty benign economic environment, and people have these concerns for the reasons we've been talking about. And so I think the BDC prices, especially after those bankruptcies of First Brands, Tricolor, whether they're public or private, doesn't really matter. It just kind of shines a spotlight that there's these kind of late cycle concerns. Therefore, the BDCs traded off pretty significantly. They've retraced a little bit in recent weeks, but they're still trading on average, if you look at the broad index, at a 9% discount. There's dispersion within that. But I think it's just reflecting that combination of dividends are likely to be cut because of the base rate and spread compression. And then on top of that, there are some fundamental concerns, as we talked about. We do think we are, if we're not in a full credit cycle, at the beginning of a credit cycle, as evidenced by elevated PIK, paid in kind interest, as evidenced by amendment activity, as evidenced by the default rate. If you look at the Lincoln data, which is typically regarded as the best source of insight into the private credit space.
These are the restructuring kind of experts that publish periodic reports on defaults and when sponsors hand the keys back to lenders, because the company's worth less than the debt load. That's the group.
Yeah, exactly.
Yeah, okay.
And they'll shine a spotlight. What is revenue growth? What is EBITDA growth? And where are default rates? And their shadow default rate for private credit is around 6% today. So pretty elevated, especially as you kind of contrast that to high yield has been sub 2% default rate for the last couple of years. That's even our forecast out to 26. Bank loans kind of sit in between, where the default rate's been hovering near the historical average of 3 to 4%. And I think that's, at the beginning you asked about how these markets are kind of interconnected. I think you can see it pretty clear in the default statistics, where high yield generally is regarded today as sort of a higher quality, more double B oriented index. The bank loan market is more of a CLO driven index with more of a single B focus. And as the markets start to segment, the private credit market is sort of delivering capital to that more low rated single B, triple C, with more flexibility to amend, PIK, do delay draws. There's a more of a control element there. So the markets are sort of segmenting. But as you take on more and more risk further on that spectrum, you would typically see higher default rates. And that's exactly what we're seeing across those three different segmented markets.
So I think most advisors listening will have heard all of these terms probably pretty frequently over the last few months, but just in case. So amendments, PIK, and what was the third that you mentioned as a
default?
An actual default.
Actual default.
It's been so long, Jason, that we
yeah.
So just walk through again. I don't want to suggest that these are always illegitimate tools to use, but they are tools to defer payment of an obligation from a borrower to the lender, right? Whether it's an amendment or a PIK. So walk us through kind of what those are, and maybe why somebody who sees rising amendments or rising deferrals or rising PIKs in their underlying investment ought to be asking some questions, shall we say?
Yeah, I think that's fair. And again, don't want to sound too negative here. There are good forms of PIK, if there is such a thing, Greg. I still am skeptical, being in the credit markets 25 plus years. My history would tell me that most PIKs end in tears. You look back at the companies that have PIKed historically, it hasn't been great from a forward return perspective. But today, as you look at the market in private credit, there's kind of two forms of PIK. There's bad PIK, which would be the companies that financed their deal in 2021 at a 0% base.
PIK is paid in kind.
Paid in kind interest. You're effectively pushing out some of your interest payment to a future date. So it doesn't mean you're not fully picking all of your interest. It's usually a portion.
Yeah. You're adding it to the tab.
Exactly. Exactly. So there's two forms of PIK that the private credit market is sort of defined today. There's good PIK, which is, hey, these are young startup companies that are still kind of growing rapidly. They're going to grow into their capital structure. So let's, and it's also a way to compete with the public markets, where public markets don't have that kind of flexibility to do a form of PIK. Mm-hmm. So it's a way to win deal flow in a supply constrained market. That is, quote unquote, good PIK. And then the bad PIK would be the 2021 vintage, where it was financed off a 0%, base rate. Growth just hasn't turned out to be, what they thought it would be. and they actually can't pay their interest and probably on their way to a default. So when you put the two together, it's around 12% of total income is coming from some form of PIK today in that BDC space. And to give context, that was in the mid single digits just a few years ago.
Right.
So it's more than doubled. And so that is what we've been seeing in the last couple of years. So this phenomenon that we've been talking about in recent months isn't really that new. We've been seeing this kind of elevated, PIK activity, elevate amendment activity. And amendment activity, to define for the listeners that aren't aware, would just be you're amending some of the terms within your covenants. If you're not meeting a leverage test, an interest coverage test, a fixed charge coverage test, you can go back to your lender and get an amendment and push that out a little bit, usually for additional form of compensation.
Right. Yeah. And typically there's been some kind of credit deterioration, and again, in the non-cynical version of it, the lender and the borrower work together to bridge that gap, help the company through, that hopefully temporary spot of trouble, and come out the other side able to repay its obligations. If you're looking at it maybe more skeptically, or you're more concerned about the economic environment, you're probably looking at both of these phenomena and saying to yourself, gosh, the interest I thought I was going to get paid today has now been pushed out, a few years, whatever the time period is. And so now I'm taking more risk on getting paid what I thought I was going to get paid. And I guess if you follow it through to the extreme, there's some level at which, if there's too much PIK in the portfolio, if there's too much interest forgiveness going on, the lender becomes unable to meet the dividends that it's paying its shareholders, or that it is upstreaming to its other constituencies, right?
That's exactly right. And I think that's why, going back to your question on some of the share price pressure that we've been seeing, these concerns are reflected on that. And you see it also in the actual underlying stocks of these managers themselves as well, where they haven't had a great year from a stock performance as well.
Yeah, it's interesting. So like looking at the BDC universe, that where we started this conversation, you mentioned kind of a 9% discount, and we should again acknowledge that runs the gamut, right? There's some that trade at premia. I don't get my Latin pluralization wrong. And there's some that trade at really steep discounts, and the average is at about a 10% discount, which it's interesting because that discount is a discount to NAV. So it's a discount to where the manager of the BDC has told its investors it has marked the underlying loans in the portfolio. And the investors are basically saying, we don't want to own that exposure at that mark. We want to own it at 91 cents or 90 cents. Again, to your point earlier, it doesn't mean that they think it's a huge credit problem. It could be they see forward rates coming, or they see short rates coming down, and they anticipate a dividend cut, and they react logically. What I think is maybe more interesting, I'd love for you to comment on, is if I'm an advisor or an end investor and I've got a choice in front of me to acquire a private BDC at NAV, which is by definition where private credit portfolios in private BDC form trade, or I can go into the market and purchase at a discount an analogous. I don't know if they're exactly the same, but an analogous portfolio. It seems pretty straightforward to me. Like I think if you took that trade, on the PIMCO trade floor and said, which should I buy, the dollar for a dollar or the dollar for 90 cents? Like the answer would be pretty clear.
Absolutely. And again, this is not something that you and I are only speaking about. This is out there pretty much in the public domain. And we did see this, by the way, in the REIT space not that long ago. I think the question on when that phenomena exists is, does it eventually trigger outflows, right? Because you should be doing the trade that you're saying across the PIMCO trade floor whenever you see that trade selling at NAV and buying at the discount. If that reverses, I think that's one of the things that people are also thinking about, where how do they handle those outflows? We saw what happened in the REIT space a few years ago. Gates did go up, and it did cause a little bit of pressure within that space. So again, just one of those lingering concerns in the back of your mind. And that's going back to the start of this conversation, against a backdrop of relative tight relative value to other opportunities that are out in the market today, because the Fed is cutting. There's been spread compression. You have these looming questions that we've been talking about the last few minutes. You should be getting compensated for that liquidity premium that you're giving up, that lack of transparency. Going back to Renovo, just as an example, that's one that really kind of. So I would say there's two things happening. You had the three bankruptcies that we talked about, where that was more related to receivables, off-balance sheet liabilities, and just kind of outright fraud with weak governance and founder owners. Like, there were some commonalities there. The one that I think kind of opened people's eyes was this week's story on Renovo, where that loan, it's a small middle market private loan, was marked at par as recently as a quarter ago. And then this week it was announced that it's actually liquidating, and the mark went from par to zero.
Right.
That is that concern that you would have, is like when you're marking things at NAV, what are you actually marking? So it's a little bit of a rabbit hole to go down there, but that is one of the things that people think about with that lack of transparency, and where are the marks accurate. And I think that, again, is one of the things kind of weighing on investors' minds.
But the point being that the valuation here is a little bit in the eye of the beholder. And we've made this point on the podcast before, that a manager managing a private portfolio can be doing everything right in terms of trying to arrive at the right mark for a piece of paper and still be wrong. And what I think is interesting about the conversation we were just having is, like, one of the things that I find interesting about the private BDC and the private REIT phenomenon is that you can only transact at NAV. Right, so you have no mechanism for price discovery, or very limited mechanism for price discovery. Your mechanism for price discovery is basically whether or not people believe your NAV. If they do, you may have inflows. If they don't, you'll have outflows, and potentially run into gating issues or other things. But that's really the only way that you can determine whether or not the market, quote unquote, believes or values your holdings at the same level that you do as a manager. Whereas in the public markets with the public BDCs, in real time, you kind of get that feedback, and it gives you a sense. And that's why I think we're watching flows in the direct lending space so carefully right now, because the public markets, again, on average, not for every issuer, are telling you that they don't value the holdings at the same level as where they're marked, and they would prefer a higher rate of return on those. And so we'll see if that then translates through to the buyers of the more private vehicles.
I think what would be a major driver of this, and you need some sort of economic shock, right? Because I think if you don't have that, if the economy kind of chugs along, you get a 2+% growth. Yes, you'll have some idiosyncratic events like we've talked about, but I don't think it becomes a full scale recession, and you're seeing deep discounts, gates go up, et cetera. I think you need some sort of catalyst to kind of make that next step happen. And right now that's not on our forecast, to be clear.
Yeah, I hear you on that. I sometimes think that one of the new variables, though, in this space is the increasing prevalence of the wealth market. And I get really, I serve the wealth market. I think the advisors that I speak to are phenomenally sophisticated, patient, good investors on behalf of their clients. And so I take umbrage when people refer to it as fast money. But I do think that advisors want to get the most for their clients, at any given point in time, and have the freedom to look elsewhere for value when they don't feel like it's apparent in their current holdings. And so there is, I think, again, there's a variable here, which is you've just got more wealth investors involved in this space than you ever have before. And if forward return expectations begin to come down meaningfully, if credit fears, evolve from just sort of these idiosyncratic headlines to something that feels a little bit more like late cycle, credit default behavior that you've already you've mentioned is we're already seeing signs of, then you could actually see some meaningful retrenchment in the space.
I think that's right. And as you were talking through that, I don't want to underestimate the risk that you're describing, because it is a real risk out there. And I would say, if I kind of back up and just summarize the way I'm thinking about that space in general, and it's not just, to your point, public-private or private only, it's public and private, is the cockroach story. It's funny, we're 30 minutes in, we haven't mentioned a cockroach once.
Yeah.
But that general cockroach late cycle behavior, how many are there, et cetera. I think Howard Marks had a funny saying on that the other day, the canary or the cockroach in the coal mine. I thought that was pretty clever.
Way to mix a metaphor, Howard. That's good. That's good.
So you got that story happening. That's number one. Number two, you got the PIK amendment default activity that we talked about. And the one that you should be thinking about as well, and that's a big story overall in the broader markets as well, is technology. We haven't mentioned that yet, but that's the third caveat that you should be thinking about in general in the credit markets. This is impacting all the way from investment grade, all the data center activity we're seeing, all the way down to private credit, where they have a lot of concentration in enterprise software. If you look across, and by the way, in the public bank loan markets as well, it's about 15-20% of the sector concentration. So all this technology concentration is something I think that is going to be a big risk factor on a go-forward basis. If you think about 30% of the BDCs or 20 to 30% round numbers are kind of exposed to technology, I think that's a big looming risk, because we just don't know how it's going to play out yet as AI gets deployed. Does it disrupt? Does it dislocate? And I would expect recoveries to be pretty nasty if you get the bankruptcy, because there's just obsolescence risk becomes the biggest risk there. These are not worth anything if the technology gets disintermediated.
Yeah, I think maybe we take a little too much comfort in prior performance, and I don't just mean in terms of track records of investment managers that we may look to invest in, but also past patterns of behavior. So software, SaaS software, right? Software as a service 5 years ago, 10 years ago just looked like an incredibly attractive, reliable, predictable revenue stream in an asset light, CapEx light company. And AI throws that for a loop, right? And we don't really know where that ultimately bottoms out, but we have every reason to expect it'll be different than maybe people assumed a decade ago. And then, the other thing you mentioned is recovery rates. There's this rule of thumb in credit investing, right, that recovery rates are usually around 60, 70%. And we just don't know, right? Because you mentioned the sector exposure has changed, but also, the documentation has changed over the years. And so I don't know in a Cov-Lite document what a lender can seek to recover in a situation like that.
Well, yeah. Actually, right before I came in today, I was reading the JP Morgan put out a study through third quarter what recoveries look like on an LTM basis, and they're pretty bad, Greg. The bank loan recovery is less than 40 cents on an LTM basis today, and historically that would be 60 to 80 cents, so well below. And I think it's the sixth consecutive year that it's come in below the historical average. So clear trend of recoveries going lower. That's a function of more loan-only issuers with less subordination in the capital structure, and also this concept of weaker governance, to your point. So these LMEs, or liability management exercises, where you have creditor-on-creditor violence with different sets of lenders getting different recoveries. That combination has been pretty brutal when you find yourselves in those stress situations in the bank loan market. Also seeing low recoveries in high yield. So it's prevalent across bank loans, high yield, and private credit.
So it's interesting. So from our conversation, it sounds like our headwinds in corporate credit generally, and particularly call it the lower quality end of that, whether it's bank loans, private credit, maybe to a lesser extent high yield, because as you mentioned, that cohort has gravitated to a slightly higher quality over time. But it sounds like we've got declining coupons for the most part in the floating rate sector, it sounds like we have some unanswered questions in terms of whether or not the cockroaches are really emblematic of broader problems. But at the end of a long cycle, there's no reason to think that's a crazy hypothesis. It sounds like there's an open debate as to whether or not, the underwriting standards and the concentrations and things that we've talked about really belong to just one market, say the bank loan market versus the private credit market, or if they're more widespread. And we have, a little bit of added economic uncertainty, though we're not calling as a base case for a major recession. It doesn't occur to me that we'll be changing our views to more bullish on any of these sectors anytime soon. And I say that full well knowing I'm talking to, the bank loan guy when I say that.
Yeah. No, I think that's exactly right. Right. And so in general, we're preaching, stay up in quality, stay liquid, be careful of the cyclicals right now. As an example, not everything is terrible. A lot of the sectors that went through some restructuring or some pressure a couple of years ago, telecom, healthcare, they've come out in a decent position on the other side of that.
You mentioned the REITs, and I think that we're constructive by and large on real estate debt. Yeah. So yeah.
And on the high end consumer, the consumer that owns a house, there are definitely places to find value within the market. I think it's, again, just kind of going back to that active management, rotating in and out of sectors as we see value, and most importantly, maintaining that liquidity. And if you're going to give up that liquidity, just make sure you're getting compensated appropriately for that.
Hey, Jason, you mentioned factoring as part of the Bankai situation, I think it was. And, factoring's something that falls in the asset-based finance category. One of the things that we like to mention to investors is that asset-based finance is not some new phenomenon that the private credit guys thought up in the last, 2 or 3 years. It's an old and established deep market that, we at PIMCO have been involved in for the duration of our history. And particularly, in some of our large multi-sector products, really, really deep into a lot of those spaces. And I guess the thrust of my question is, I've always thought that entry barriers to being really good in asset-based finance are pretty high. Just being able to conduct diligence on, that variety of assets, to have, maybe had some of the scars related to being defrauded or, where the assets aren't where they're supposed to be. I know this isn't your daily area of focus, but what's your impression of some of the differentiation between the corporate lending landscape right now versus the asset-based lending landscape?
Yeah, it's an interesting question, right? Because as a firm, we're definitely favoring asset-based financing as a better relative value trade today. But with the caveat, it's becoming also a little bit of a crowded trade. And I think, as the private credit corporate markets have kind of matured, you're seeing a lot of these managers kind of pivot over to that asset-based finance market, and therefore they're not as entrenched in the space. They don't have the resources, the history, to your point, of kind of doing the deep dive. And if you look at, it was First Brands and Bankai, just basic diligence wasn't done. On Bankai, it was outright fraud where they were making up transactions and mailing them in when there was actually no telecom company. They didn't have any customers on the other side. At PIMCO, we kind of pride ourselves on doing our own diligence there, having great resources to kind of verify the collateral, and then being careful where we are doing the type of asset-based financing as well. Again, reinforcing where the consumer, it's the high-end consumer, pools of collateral, whether bespoke or public, where there's, typically where they own a home, right? The stark contrast between a homeowner's net worth and a non-homeowner's net worth is as big as it's ever been. And we'll focus on those areas of the market where I don't know if the broader market is being as discerning as they navigate that space.
Yeah, I think the point about asset-based lending that I find most compelling is it does carry some additional risks in the sense that more granular asset base. Some areas of asset-based lending are not like others, right? It's a big category. But if you bring to it tested institutional processes, we think that you can take advantage of what is today still a far less crowded landscape than what you see in corporate direct lending. And then we also, I think it's really important to mention to advisors that just because it's less crowded today doesn't mean it will be less crowded tomorrow. And so we all have to keep an eye on that and not fall into the trap that maybe folks have in the direct lending space of late, which is to assume that because the last 5 years have been great, the next 5 years will be great. Everything's cyclical. Capital chases returns go down. It's the oldest story in markets. And so we just have to be vigilant about that. And to your point early on in the conversation, stay active. Some of these private credit strategies to us look as passive as an index, right? It's doing, I'm exaggerating, but doing every loan that crosses your desk. Well, that's not selectivity. That's not care. That's capital deployment. And that's you can do that. And if you get the beta right, it can be very successful, but it's not active management.
Exactly right. And even going back to your point on the ABF, right? It's not just, which tranche are you investing in? Are you up in the cap structure? Are you down in the mezz tranche, et cetera? Because different parts of that asset-based finance. And it's hard to speak in like such high level because it is so nuanced across all these different kind of subsectors.
All right, Duko, thank you so much for spending the time with us. I think, there's a lot going on out there. There's a lot to parse through. And you've given us a really, I think, measured and balanced sense of the pushes and pulls on the credit markets right now. I think advisors, it's a great framework that you've given them. They can take this to their clients. They can talk about on the one hand and on the other, which, sometimes is better than, banging the table one way or the other, because these are complicated, nuanced things, and they deserve, some careful thought. So thanks for bringing that to us. We really appreciate it. Love to have you back sometime. Maybe next year, as some of these trends work themselves out, we'll be able to test whether our hypotheses and our frameworks actually held true.
Great. Well, thank you for having me, Greg.
All righty. Hey, thanks everybody for listening. We will be back next month with another great podcast. We really appreciate you spending the time with us on Accrued Interest. As you know, Accrued Interest is part of the Advisor Forum platform here at PIMCO. Advisor Forum is your destination at PIMCO for the research and the insights that you need to make for quality client conversations and to make your days as efficient and pragmatic as possible. We really appreciate you spending the time with us, and we'll talk to you next time.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.